So hello and welcome to today's webinar session. Greetings to all from Enrich. In today's session, we will look into a few more important candlestick patterns. But before that, I would like to recap on a few patterns that may be confusing for some of you. So if you're new to this session, you can check out our previous sessions in our YouTube channel, Enrich Academy. You will find lots of other videos on trading strategies and terminologies over here. And also, we have a complete guide from start to end on how to open an account with us, right? So if you have a confusion about opening an account, here you have Enrich Online Trading and Demat Account Opening, right? And you also have a complete 10 minutes video which tells you about the web hunt login as well. So the reason why we tell you to open an account is so that once you finish up with all these webinar sessions and practicing, it's a good opportunity for you to go by yourself and trade with your own trading platforms, right? So we offer you 4 trading platforms: Web Hunt, Mobile Hunt, Market Hunt, and Nest. Web and mobile are pretty popular with our clients, so you can go ahead and click Web Hunt. Once you open an account with us, all the passwords and user IDs are the same for these platforms. So if you click onto that, you can pretty much get into the Market Watch page and start to identify the different candle patterns by yourself. And it's important to train your eyes to look at the candle patterns and spot it by yourself, right? So over here, if you would like to partner with us as well, once you've logged in and opened an account with us, you also have the opportunity to get 20% of the brokerage every month into your account, which is a pretty good scheme from us. Okay, so all you need to do is when you receive a client code, just type in your client code here and generate the link and copy the link and share it with your family and friends, right? And you don't need to worry about taking care of their accounts because Enrich takes care of the entire process, right? Okay, so let's start with a recap. So in our previous session, many of you had doubts about certain patterns which look the same, right? So I have chosen for you 6 patterns which are more or less looks the same. So the first 2 patterns are hammer and hanging man. So if you look at the candle, it's a single candlestick, but it looks the same, right? Now the point to note here is not the color of the candle. The candle color can be green or red, it doesn't matter. But where do you find it? The location of this candle is very important, right? So if you look at the first candle, which is a hammer, it can be seen after a downtrend. There was a strong downtrend downwards, and then you spot a hammer, after which it signals a bullish reversal, okay? So this hammer is seen at the bottom of the chart, remember that. But what about hanging man? It's just the opposite. It looks the same, but the location is on top. It's not at the bottom. The location of the hanging man is at the top. And this comes after an uptrend. So when you see a hanging man or a hammer kind of candle on top of the chart, remember it's a hanging man, and after this there is a downtrend. Now it's very easy to remember. The name itself suggests that it's a negative trend, right? Hanging, when you think about a hanging man, it's not a positive signal, it's a negative signal, right? So a negative signal means a downtrend. So just remember that point. Hanging man comes on top and it signifies a bearish reversal, okay? The next 2 which look alike are inverted hammer and shooting star. Again, it is similar to the previous patterns that I said. Inverted hammer is just like the hammer. It is seen after a downtrend and it signifies a bullish reversal, okay? So you can see that the bears were strong here and you see an inverted hammer, and then you have a confirmation with a bigger bullish candle and you see that there is a reversal on top, right? A similar candle which looks like an inverted hammer, but it's not an inverted hammer, it's a shooting star. So again, the color doesn't matter here. What matters is the location in the current trend. The inverted hammer is located at the bottom of the chart, whereas the shooting star is located at the top of the chart, right? Again, a very easy way to remember this, where do you spot shooting stars? You spot it in the sky, right? Which means it's on top, it's above. So whenever you see this pattern, remember that you need to spot this on top. The shooting star which comes on top is a bearish reversal pattern. Okay, so don't get confused. An inverted hammer, if you spot it after a downtrend, it signifies that the trend is changing upwards. A similar candle, which looks like an inverted hammer, but if it is seen after an uptrend, it means the trend is going to go down. Okay, and this is a shooting star. Okay, now the last recap over here would be bearish engulfing and harami. Now, if you closely notice both the patterns, you can see that one candle covers the other candle. Likewise over here, this also looks like the first candle is covering the other candle, right? Now, it's very easy to spot this as well. In engulfing, whether it's bearish engulfing or bullish engulfing. For example, I have taken bearish engulfing. The second candle, both the patterns have two candles, remember. The second candle, which is a bearish candle over here, engulfs or covers the first bullish candle. Okay, so this signifies a very strong bearish reversal, which means that the bears have come back into the market and they are being very strong here. Okay, so remember, in engulfing, the second candle covers the first candle. Now this candle can be green. If it is a green, it indicates a bullish reversal. It goes on top. Okay. For example, I have taken the bearish engulfing for you. Okay. The harami on the other side, if you look here, the second candle is kind of small. The first candle is big, right? So the second candle is inside the first candle. Okay. Here also, you see that the trend is moving downwards. A bearish reversal happens, right? Now, what is the difference between the two? If you look at the body of the candle, it's pretty small, right? But here in engulfing, the body of the candle is pretty big. So if you remember in our previous session, I had mentioned the body, the wick, and the body's connection is very important, correct? So if you see a big candle, a candle which has a really big body, it means the strength of the seller or the buyer is pretty strong. So in this case, engulfing, you can say it's a very strong bearish reversal. In harami as well, it is a bearish reversal, but compared to engulfing, it is not as strong a bearish reversal. Okay, so these are the 2 points that you need to remember. In engulfing, the second engulfs the first. In harami, the second does not engulf, it goes inside the first one. Okay, and that's why it's called harami. If you remember, the meaning of the term harami is being pregnant, right? So this small candle is located within the first candle body. Okay, so I hope that's a pretty good recap for you. All right. And also remember that engulfing pattern is a trend reversal pattern, and it must appear in an existing trend. So it is more reliable if it appears at or near a support resistance line. Okay, this engulfing pattern can be more confirmed. You can confirm this pattern if you spot it at the resistance line or the support line. Okay, the resistance and support will be held in another session in which we will elaborate much better. Okay, so let's move on to the first candle of the day. And before that, like I said, you need to understand how to read the candlestick. No matter what pattern you see on the live chart, if you do not understand the concept of reading the chart or reading the candle, it's going to be difficult. So I want to repeat this again for those who are new. If you spot a candle body which is really big, it can be green or red, it signifies the strength of that market. So in this case, you're seeing a large green body, which means a bullish candle. So it signifies that the buyers are very strong here. Okay. And if you look at this candle, the body is pretty small. So this signifies weak buyers. Likewise, if you see a big red candle or a bearish candle, it signifies strong sellers. And a small red candle would signify weak sellers. So what about the wick or the shadow? If you see a small shadow, it talks about a weak price rejection. Now, whenever you see a shadow on top or down, it actually tells you the rejection of price by the buyers and the sellers. So how do you know if the price rejection has been strong or weak? A small wick tells you that the price rejection has been weak. So to put it in simple terms, this is a bullish candle. So the opening is here, right? So it went all the way up. The price went all the way up over here, and this is the high. And there was a small rejection and closed here, correct? But in this candle, if you see again, the candle opened here and went all the way up. And then there was a strong price rejection, and the price closed over here. So you see the difference, right? Now, in the coming candlestick patterns, you need to understand this concept. That's why I just repeated these points for you. So let's move on to the next pattern, which is Morningstar. Now, what does Morningstar mean? A Morningstar is basically a 3 candlestick pattern, as you can see here, and it shows a bullish sign in technical terms, okay? So Morningstar forms after a downtrend, as you can see here. Let's look at here. It forms after a downtrend. The bulls are pretty much strong here, and it's basically a sign of reversal from the price trend, okay? Now, usually traders look for the formation of a Morningstar, and then they seek confirmation using their additional indicators. Now, about indicators, again, we will deal it in another session, okay? Now, the first candle here in a Morningstar is a bearish candle. The second, as you can see, is a doji. It can be green or red. So when you see a doji, it means both buyers and sellers are not quite sure here, okay? There is an indecision happening over here, okay? And the third tall candle is a green candle or a bullish candlestick, which shows that the buyers are back in the game. They are back in control, correct? Now, the middle candle in the Morningstar shows that the market is having some kind of indecision where the bears begin to give way to the bulls, which means the bears have lost control. They are much tired. They've been pushing very hard. But when you see this green candle, you understand that the bears are tired and the bulls are back in the game, okay? So Morningstar is best when it is backed up by volume and some other indicator like a support level. Okay, so if you have a trading platform, a charting platform, you can see all these indicators and support level and volumes on the chart, right? Okay, so this is pretty much about the Morningstar. It comes after a downtrend. It signifies a bullish reversal, okay, which means the downtrend can be connected to night. So after a night, you see a Morningstar and the day begins. The next one is just the opposite of the Morningstar, which is an Eveningstar. So the Eveningstar pattern is viewed as a bearish reversal. You can see here. And it usually comes after an uptrend. And it's spotted on top of the chart. So in this pattern, okay, let's see in a bigger chart here. So in this pattern, you see here the first candle. So let's imagine that this is a daily chart. So this is a candle of day 1, okay? So on day 1, you have a long bullish candle. Day 2 is a small bearish candle, okay? And day 3 is another large bearish candle, all right? So these can be signified depending on your time frame. So if this is a 1-hour candle, then this is a 2nd-hour candle, and this is going to be the 3rd-hour candle. So because I'm talking about a daily chart, so we're going to call it day 1, day 2, and day 3, okay? So the first part of an Eveningstar reversal pattern, as we see here, is a large bullish green candle. Remember that. So on the first day, you can see that the bulls are definitely in charge, which means the buyers are in charge, okay? The second day begins with a gap up. As you can see, there is a gap up here. And it's clear from the opening of day 2 that bulls are in control here, okay, because there is still an indecision over here. However, bulls do not push the price any higher. You can see that the bulls have become tired here and they have given way to the sellers or the bears, okay. So this middle star is called an evening star because now the day has ended and the evening has begun, and you can see that there is a bearish reversal, okay. And you can also see that there is a gap down. Day 3 begins with a gap down, which again signifies a bearish signal. So the bears are able to push the prices further down the market, okay. It's very simple over here. All you need to remember is you need to spot this on top of the chart. There are 3 candles over here. It comes after an uptrend, followed by a neutral candle, and the bears push the price further down to a bearish reversal, okay? All right. The next is tweezer top and tweezer bottom. Now, what is a tweezer? So just for your understanding, look at this picture here. This instrument is called a tweezer. I'm sure many of you have it at home. You normally use it to pick up small, tiny things, right? Now, if you look at the bottom of the tweezer, both these are at the same level. It's not up or down, right? It's at the same level. Now, the concept of tweezer is also the same, okay? If you look at the 2 candles over here, the high of the candle has to be the same. That is the concept. In the bottom, the low of the candle has 2 candles have to be the same. So let's look at it in detail. Have a look here. The tweezer top formation is viewed as a bearish reversal, as you can see, and it forms after an uptrend, okay? You need to have 2 candles. Sometimes you also have 3 candles, okay? Like you see it over here, there are 3 candles here, and sometimes there are 2 candles. But the first 2 candles, high, if you can see, this is the high of the first 2 candles, it has to be the same. So if I draw a resistance line here, this portion, this line over here can be a resistance level. These 2 must be at the same level, okay? So the first day's candle is a bullish candle. The second is a bearish candle. Okay. Now we move on to tweezer bottom, which is exactly the reverse of tweezer top. So tweezer bottom formation is viewed as a bullish reversal pattern. As you can see, the trend is moving upwards. And in this, you have 2 candles. The first is a bearish candle. The second is a bullish candle. But what about the shadow? The low of both the candles are same, which means this line that you see here is a support line. So on the support line, these 2 lows must be at the same place, okay? Now a bullish tweezer bottom occurs during a downtrend, okay? When bears continue to take the prices lower, usually closing the day near the lows, okay? But the day 2 is completely opposite because prices open and go upwards. Now the pattern is more important when there is a strong shift in the momentum between the first candle and the second candle. Okay, so for trading purposes, these patterns are best used to indicate the end of a pullback. Okay, but remember, no pattern is perfect, and tweezer patterns does not always create a complete reversal. Okay, so use these candles that occur after the pattern to confirm a short term. So always remember, whenever you look at the live chart, don't just spot one pattern and stop there. Okay, always remember, to confirm this pattern, you need another candles that confirm the same kind of trend. Now, if you look at these two candles, the body of the candle differs. One candle is small, the other candle is big. In these, they're kind of the same. In the previous one, if you see here, the first candle is small and the second candle is big, right? The body of the candle. So the body of the candle doesn't matter. What matters here is the wick. So in Tweezer Bottom, the wicks, the two candles wick must be the same. In Tweezer Top, the two candles wick must be the same at the highest level. Okay. So to wrap it up, for a bottom pattern, a stop loss can be placed below the tweezer's low, right? So when you're placing a stop loss in Tweezer Bottom, if this is the low, you can put it below this level. Okay. For a topping pattern, the stop loss can be placed above the high. So this is the resistance level, so you can place it above the high. Okay. So the point to remember is that tweezers do not provide a profit target. The target must be based on other factors like the trend and the overall momentum of the trade or the market. Okay. Let's move on to upward gap Tasuki. Now, an upward Tasuki gap is a 3 candlestick bar formation. Okay, as you can see here, there are 3, 1, 2, 3. Okay, and what this pattern normally does is it signals the continuation of the current trend. So if you see, there has been an uptrend and you spot the Tasuki, but there is no reversal. The trend continues, right? So a Tasuki actually in Japanese term, just for your information, it's a cord or a long sash. As you can see in the picture, this white cord or a sash is called the Tasuki. Now what you see here is a kimono. Kimono is a traditional Japanese wear, okay? And if you can see, the sleeves of the kimono are quite big, right? So when they work out, when they do a cooking or some kind of exercise, it's going to be a hindrance for them. So in order to avoid that, they tie this Tasuki so that it helps them to tuck their sleeves of the kimono, right? So basically when they do this, when they tie this, there is a gap. So the meaning of the term Tasuki comes from the gap, okay? This is just for your information. Now, let's look at what it actually is. Now, the first bar, let's look here. The first bar, as you can see, is a large white or green candlestick, okay, with a clear uptrend. Now, it can be white here. If your charting platforms have a black and white candlestick pattern, then instead of green, you can see a white, and instead of red, you can see a black, okay? The second bar, or the second candle, is another green candlestick with an opening price. This is the opening price, and it opens where? After the gap up. And you can see that there has been a big gap up over here, right? So it is gapped above the close of the previous candle. So this is the close of the previous candle, and this is the open of the second day candle. So there has been a beautiful gap over here, suggesting that this is a strong continuation pattern, okay? Now, day 3, you see, it's a red candlestick, and where does it close? It partially closes the gap between the first and the second candle, okay? Now, here you need to remember, when this candle closes, it should not cover the gap, okay? This is something that you need to remember in a Tasuki gap. The third candle must not cover this gap. It should close somewhere in between. If you see a candle that closes the gap, it becomes an invalid pattern, okay? So if you look at the chart as well, you see the third candle, it goes down, but it doesn't cover the gap. It closes between the gap, right? So let's try to understand the upside Tasuki gap. So what it displays is the bull's strength through the gap open of the pattern's second candle, okay? It also signifies a rising price, right? The pattern's third candle over here, it indicates a pause in the trend. What do you mean by pause? A stop. So when you see that the bulls are taking control and suddenly you spot a red candle, it means that the bears are trying to get into the market. They are trying to attempt to push the price down. But again, you see that they are not able to cover the gap and the bulls are back in control. Okay, so the bears' failure to close the gap suggests that the uptrend is expected to continue for more time. So here what happens usually is traders may also refer to this pattern as bullish Tasaki or upward gap Tasaki, right? And this is one of the many gap patterns that can form throughout the bullish trend. So you can see this pattern in between the bullish trend. Now, the way to trade strategically is to spot other supporting uptrend patterns and use them in connection with the Tasaki gap in order to confirm that this is a bullish trading strategy. Okay, so like I said before, don't just be stuck with one pattern. To confirm this, try checking out other candles and check if the patterns are moving upward. Okay. Now, gaps are important price changes and usually happen from one trading to the next. So whenever you spot a gap up or a gap down, it shows a significant change in the market. Okay, it shows a reversal or it shows that the trend is moving stronger. Okay, so sometimes traders push the price higher too quickly, which can result in a slight pullback. So what we see here is that the red candlestick, the bearish that forms the upside Tasaki gap, acts as a period of minor consolidation here before the bulls continue to send the prices higher. That's what you need to remember. Okay. Okay, let's move on. Downward gap Tasaki. It's just the opposite again of the upward Tasaki, and is commonly used to hint the continuation of the existing downtrend. You see that there's a downtrend, the bears are in control, and when you see it a downward Tasaki, it shows that the trend may continue for some more time. Okay, so in this case, the first bar is a red candlestick within a clear downtrend. Okay, the second bar is another red or bearish candlestick. But where does it open? It opens after a gap down. You see there is a gap down. The third candlestick, which is a bullish or green candlestick, yes, and it closes within the gap of the first two bars. Okay, so the third one is a bullish candle which closes within the gap of the first two candles. Again, the point to remember is this must not cover the gap. If it covers the gap, it becomes an invalid pattern. Okay. So let's break this down. The green candlestick that forms the downside Tasaki gap over here, this candle acts as a period of short or minor consolidation before the bears continue to send the prices further down. Okay. So in technical analysis, if you see, it is common to see that the price of the asset closes the gap created in the price. So sometimes traders get ahead of themselves and send the price lower very quickly, okay, which can result in a slight retracement. Okay, so now when I talk about retracement, you need to understand what retracement is, right? We will talk about this in detail in a completely different session, but just for your information, I would like to give you an understanding of the difference between retracement and reversal. So it's important to distinguish between reversals, which breaks the current trend, and retracement, which is within a trend. Okay, so don't confuse yourself with retracements and reversals, because that's why some traders lose money. Okay, so here you can see that there is a support line, diagonal support line. Okay, this from here to here, if I draw a line, it's a diagonal support line, and here horizontal lines would be another support, right? And if you see the shaded area here, you can see the shaded areas. These areas from this point to this point, the first thing you need to know is this is an overall uptrend. It's moving upwards, right, in one direction, the highs and the lows, right? So from this point to this point, from this point to this point, and from this point to this point, these are not reversals, these are retracements. Okay? Meaning a retracement means a temporary reversal, and it's completely different from a reversal. Okay? So in this case, these areas are not selling opportunities. So sometimes people mistake this for reversal. Okay? But if you see the point from this to here, this is a complete reversal. Okay? So I hope this is clear, but in detail, we will definitely deal with this in another session. Let's move on to Marubozu. Now, Marubozu is a lovely word as it feels, right? And it's a very calming concept because after you have seen a lot of complex candlestick patterns, it's always nice to get to the basics, right? So it's like the doji. The Marubozu candlestick pattern is one candle. It's easy to spot. You can easily spot a doji. Likewise, you can easily spot a Marubozu candle. Okay, it's a single candle, and the meaning is very clear. It comes both in bearish, that is red, and bullish, green candle. Okay, and what it actually does is it commands attention with its long body. Okay, so when you see a long-bodied candle, you actually look at the candle, right? So it commands attention of the traders. So if you think you found a Marubozu candlestick pattern, you need to look for the following criteria. First, the single candle should have a long real body. Second, there must not be an upper or lower wick. Now, if you see in real life charts, sometimes you may spot a very slight wick over here. That's acceptable, but mostly they do not have wicks on the top or bottom. Okay, that's all there is to it. You're looking for a big block without any extra wicks or shadows. So this the signal can be green or depending on the charting platform, green or white and red or black. Okay. So what is the meaning of Marubozu? Marubozu in Japanese basically means bald head or shaved head. That's why there are no wicks, right? And when you see a Marubozu candle, the fact that there are no wicks tells you that the session opened at the high price of the day and closed at the low price of the day, right? So this opened at the high price and closed at the low price. So in a bullish Marubozu, the buyers maintain control of the price throughout the day from the opening to the close. Whereas in a bearish Marubozu, the sellers control the price from the opening to the close. That's what it means, okay? So depending on where a Marubozu is located and what color it is, you can make predictions, right? So if you see a green Marubozu at the end of an uptrend, it shows a continuation of uptrend, which means imagine there has been an uptrend and you see a Marubozu there. It does not mean a reversal, a green Marubozu. It means the trend is continuing, okay? But if you spot a green Marubozu at the end of a downtrend, there is a downtrend here, and you see a green Marubozu, it shows a reversal because a green Marubozu is a long candle body which shows the buyers are pretty much strong here, correct? Likewise, the opposite. If you spot a red Marubozu at the end of a downtrend, there is a continuation pattern. But if you spot a red Marubozu after an uptrend, it shows that the bears are back in control and there is a bearish reversal. Okay? However, what you need to remember is all these are just probabilities and there is no 100% certainty here. It's always best to confirm your suspicions by watching the candles that appear after the Marubozu and the other candles, right? So if the next few candles confirm your forecast or if you spot other supporting candlestick patterns for that trend, you can go ahead and move forward with confidence. Okay, so don't just be stuck with one pattern, always confirm with the next couple of candles. Okay, next we come to the rising three. So what is the rising three method? The rising three is a bullish continuation, as you can see. and it happens after an uptrend. Okay, the important point over here you need to remember is there are at least 5 candles. Okay, the first and the last candle are bullish. The candles in between, they are bearish. Okay, you can either have 2 or more short candles over here. Okay, these candles, as you can see here, these are bearish candles. Okay, now normally these bearish candlesticks should not exceed the range of the first candle, which means these candles must be within the range, within the body, the high and the low of this candle. Okay, as you can see here, it's within, right? The last candle completes the pattern and should open higher than the close of its preceding candlestick. Let me show you a clearer picture here. Here you are. So you see here, the first is a bullish candle. These 3 are bearish, and you can see that all these 3 are within the range of the first candle, correct? The last candle is a bullish candle again, and this is an important candle to look for confirmation. Okay, and if you see, where does it open? It opens above. It opens above the close of the previous candle. And where does it close? It closes above the high of the first candle. That is important. The closing of the 5th candle must be above the high of the first candle. Okay, so here the bulls are in firm control. Before pausing to see if there is enough conviction, there is a pause over here, and then they move ahead. Correct? Now these 3 candles show you a consolidation before the uptrend continues. Okay, so the significant strong bullish candle over here, the 5th candle, is a proof that sellers did not have enough confidence to reverse the previous trend and that the buyers have taken control of the market. All right. Next we come to the falling 3, which is the opposite of the rising 3. Falling 3 is the opposite of the rising 3 and appears after a downtrend, as you can see. Yes, the first candle is a red bearish candle, followed by 2 or 3 bullish candles. Okay. Again, these bullish candles should not exceed the high or low of the first candle. Okay, they should be within the range of the first candle. The last candlestick that completes the pattern, this one, should be below the close of the first candle. Okay, and should close lower than the close of the first candlestick. If you see here, this is the first candle, this is the close of the bearish candle. The 5th candle should close below the low of the first candle. Okay, you can look at here, this is a clearer picture over here. Yeah, this is the 5th candle, this is the low of the first candle, and you can see that this is closing below the low of this candle. Okay, so the falling 3 method is important because it shows traders that the bulls do not have enough confidence at this point. They are trying to push into the market, but they have failed to push the prices further up. Okay. So let's have a quick recap of this. The first candle is a long bearish candle, correct? And it's within a defined bearish trend, downtrend. The series of the small bodied candles, okay, that trade below the open or high price and above the close or low price of the first candlestick, which means in simple terms, it should be within the range of the candle. The 5th candle, the final candle, should be a long bearish candle that cuts the low of the first candle or breaks the low of the first candle and moves downwards, okay, indicating the bears or the sellers are back in the game and they have taken control. Okay. Now all this might be a little confusing for some of you. Not to worry, all this is uploaded, will be uploaded onto our YouTube channel, Enrich Academy. Whenever you have time, please do go backward and rewind and watch it so you can understand better. Okay. Let's move on to bullish kicker pattern. A bullish kicker is a candlestick pattern that often is formed after a significant downtrend. If you can see the chart here, okay? So bullish kicker consists of a large bullish candlestick. These two candles make the bullish candle, bullish kicker pattern, okay? How do you identify this, okay? The pattern starts with a bearish candle. If you can see the small bearish candle over here, this is actually kind of a hammer. If you remember, a hammer comes after a downtrend and signifies an uptrend. It signifies an uptrend, right? So you see a small bearish candle here first, and then you see a gap up opening. The second candle opens after a gap up and opens above the previous day's close. So this is the previous day's close, and this one's opening above the close, remember. And it continues straight up and ends up as a bullish candle. So the gap should not be filled by the wick of the candle. Again, remember, the wick should not be big to cover the gap. Okay, in other words, the candlestick should have a tiny wick or sometimes no wick at all. Okay, so what does a bullish kicker mean? The pattern begins with a bearish candle, right? Okay, the pattern begins with a bearish candle, correct? Which tells us that the bears were in control. They are in control till this day. They managed to push the market further down. That is what the wick shows, right? However, when the second candle is seen on the second day, the tables are turned and the bulls take control of the market. The market gaps up. It opens with a gap up. And this shows that this shows the strength of the bulls. Now the second candlestick continues and confirms what the gap above the previous open showed. It shows that the bulls are still in the market and the trend is going to continue for some more time. So as you see, bullish kicker is quite a dramatic pattern, because imagine this candle was yesterday's session and this candle is today's session. So until yesterday, if you are a trader, you would imagine that the price would further go down, correct? But the next day when you wake up, you see that the pattern is completely reversed and it's moving upwards. That's why it's called a kicker pattern. A kick on, like it's a kick on your face, right? You do not know what's happening and suddenly the market has reversed towards the top, right? Now, how do you gauge the strength of this pattern? How do you understand the strength of the kicker pattern? So the bullish kicker is a candlestick that's all about market strength, remember. It shows that the market is either starting to recover from a downfall or it has regained some strength from the upward trend. So these are the 3 points to remember before you start trading with this pattern. You need to remember the measure of the distance of the gap, distance between the gap as you have seen. Measure the range of the candlestick, meaning measure the body. Is it big or small? And look at the length of the wicks. So considering that, imagine that you want to enter trade because the market shows that it's strong enough to continue upward, right? It could be logical to assume here that it's better if the gap is big, okay? I'll show you again. It's better if this gap is quite big. The range of the bar, the body of this bullish bar should be big compared to the previous bar, okay? And the wick of this bar should be small. So these 3 signs show that the market has acted in a very powerful way. And it could also help to increase the accuracy of this pattern, okay? So depending on how the pattern works in the market, it could actually be that it works better in the opposite way. For example, a large gap to the upside could become a sort of exhaustive gap where the market simply has depleted all its resources and won't go down, correct? So what do you conclude from a bullish kicker pattern? It's an explosive and powerful pattern, okay? And it should not be overlooked. When you look at the kicker pattern, you must wait for confirmation, okay? So most traders traded amongst this, place it amongst the strongest patterns in the candlestick pattern. So when you spot it, be prepared for an action, okay? Okay, let's move on to our second last pattern, which is bearish kicker pattern. There's one more pattern to go. To identify a bearish kicker, check for the following criteria. You can look at the chart. First, there must be a green candle or a white candle depending on your charting platform. The color of the candle varies depending on the charting platform. Okay. The second is a bearish candle, as you can see, can be red or black, and opens after a gap down. Okay. So what is the meaning? When the first candlestick opens, the price has an upward direction, which means a rising movement continues throughout the day. So if you're looking at the chart over here, today, for example, it signifies that the market is going upwards, and you don't have an idea that the market will go down the next day, right? And that's again why it's called a kicker pattern, right? The following day candlestick opens at or near the previous day's opening, okay? The price never rises to the previous day's opening. As you can see, it doesn't rise, yes? So what's happening here? Due to this significant change in direction, it's usually safe to assume that the second candlestick's downward movement will continue for some more time because it's a huge body, and you can see that it's basically like a marubozu. If you remember, there are no wicks, right? And it's a huge red body, so it's a bearish marubozu. And when you see a huge body, it indicates the strength of that particular trend. So in this case, it indicates the strength of the bears or the sellers. So bearish kickers often appear after a startling news event. You may have a sudden event that causes an abrupt change in the sentiments of the traders or investors, or it could be before the market hours or after the market hours. Okay, so this kind of pattern happens suddenly. Okay, and it's quite dramatic. And here you can see that there is a high level of selling pressure. That's why it's going down. Okay. So the points to remember is the longer the candlestick, the more dramatic the reversal is. And the larger the gap is, the more significant the reversal. 2 points to remember here: the length of the candle and the gap of the candle. And also note that there are no wicks, okay, to cover the gap. Okay, let's move on to spinning top. Spinning top resembles the doji. Now both patterns feature a single candlestick with a long wick or a shadow on the top and the bottom. Okay, but what is the difference between a spinning top and a doji? A doji mostly does not have a body, okay, a very slight body. The close and the open of a doji might be almost the same. Whereas in a spinning top, you have a body, but it's pretty much small. The wick and the shadow is pretty big in a spinning top. Okay. So if you're looking to identify a spinning top candlestick pattern, seek out a single candlestick with a short body, as you can see here. It's a small body. Okay. And long wicks, upper wick and lower wick. The color of the spinning top doesn't matter. It can be green or red. So what is the meaning? Why is it called spinning top? Now, when you think of spinning top candlestick, it's like the toy. If you remember, you might have played with this toy when you were a child, right? So what does this do exactly? When it's spinning smoothly, you cannot say when it's going to fall and to which direction it may fall, right? It can fall either ways. You cannot predict. Similarly, a spinning top candlestick pattern represents indecision in the market. Okay. Here, neither the buyers nor the sellers have control. It's a neutral. It's kind of a neutral candle. Okay. So as we can see in the short body of the candlestick, the market hasn't changed much since it has opened. That is what you need to understand. Okay. We can also see that during the specified time period of this session, of this particular session, the buyers and the sellers both had an advantage at some point or the other, because you can see that there's a wick on top, there's a wick on down, and there is a small body. So both buyers and sellers had an advantage over here, but still there was not a strong push in the market by either the buyers or the sellers, right? So if you spot a spinning top after an uptrend or a downtrend, it may signal a reversal is on the way. So if you see there has been a downtrend here, you spot a spinning top, and the next candle after the spinning top is what gives you the confirmation of the trend, whether it's going upwards or downwards. In this case, you see there is a huge bullish candle, so you can confirm that the market is likely to go upwards. Okay. Now, due to this indecision and uncertainty, it's hard to know where the market will move next. Okay, so until you have a clear picture, be very careful and don't make any rash decisions when you see a spinning top, all right? As we've said before in our previous sessions, always make sure to balance your risk to reward ratio, have a clear idea of your profit and loss, make sure to punch in your stop loss as you enter. No matter how good the market looks, it may look profitable, okay? But doesn't matter. Never trade without a stop loss, okay? Now, apart from these sessions, you need to train your eyes to spot the candles, right? So move ahead and look at different charting platforms, look at the charts of previous 2 to 3 years, and practice trying to spot the candlesticks before you start trading, okay? It's important to train your eyes. So if you see here, this is a site, investing.com, where you can see different candlestick pattern formation, right? So try to move back and check what are the candlestick patterns, right? You can also get into web hunt, as I've said before. After opening an account, you can actually work with these patterns when you are at home or even while traveling, because mobile hunt is something up in your mobile, right? And you can spot the difference. You see here in this place, there is a huge gap up. As said, whenever there is a gap up or a gap down, know that the trend is going to reverse, right? And there is a doji formation here, right? The trend is reversed. Have a look here. There is a gap down here, right? So this is how you spot. You just have to keep moving and checking the patterns. Over here, you see there is a gap up, there is a doji, a long leg doji, and it's moving upwards, right? So whenever you see a gap up, whenever you see wicks, long wicks, know that there are big players in the market, okay? So I hope that this session has been useful to you. Always remember that history repeats itself, which means, what does it mean? It means what you see in the future is nothing new. It is just the past presented in the new way. So when you look and practice the past trends, you will realize that the new trends are just something similar to the past trends. Okay? So until next session, keep practicing. Also join us for our Tamil session tomorrow, which is on trading strategies using moving averages. If you're comfortable with Tamil, please do join us for tomorrow's session. Thank you for joining today. Have a good evening.